Hello and welcome back to Investment Research. Today we have an important video. We need to talk about what's happening with this stock because things have gotten interesting. As I'm recording this, we're trading around $24.91, down nearly 7% on the day. But here's the thing, we're down about 24% from the all-time high of $32.73 we hit just 9 days ago on November 12th. So what's going on? Why is this dropping? Is this just a healthy pullback or is something fundamentally broken? And more importantly, what should you be doing right now? Here's what I'm covering. First, I'm going to show you exactly why the price is dropping with actual data, not just speculation. Second, we need to talk about the Fed's December decision because this is critical for lending businesses. And third, I'm going to give you my projection for 2026 based on what Wall Street is actually saying. All right, so first question, why is this stock getting hammered in this exact period? Let me walk you through the actual reasons with proof. Reason number on technical breakdown. After overheated run, look at what happened. The stock hit $32.73 on November 12th. That was the peak. Since then, we've seen a sell signal from a pivot top, and technically we're down 13.6% from that point through last week. Now we're extending that drop today, down another 7%. Here's what the technical picture is showing. Both short-term and long-term moving averages are flashing sell signals. The MACD, which is the moving average convergence divergence indicator, issued a sell signal about 3 months ago. When you see these technical indicators align, it usually means the momentum has shifted. But here's the key thing, volume has been falling alongside the price. That's actually a positive sign because it means this isn't panic selling. It's more like profit taking after a massive run. Remember, we're still up over 80% year to date, even after this pullback. Reason number 2 for me was valuation, reality, check. The second reason is simple. Valuation caught up with reality. This company is trading at 47 to 50 times forward earnings. That's more than double the market average. Price to sales is around 6 to 7 times. Traditional banks trade at 2 to 3 times sales. Now, I'm not saying this valuation is wrong for a high growth fintech. But here's what happened. The stock ran up 230% this year, while the fundamentals, though strong, didn't triple. The market got ahead of itself. When that happens, any excuse becomes a reason to take profits. Forbes just published a piece asking if investors should buy at $27, and their conclusion was cautious. They said the operations are strong, but the valuation is rich. That kind of Wall Street skepticism creates selling pressure, reason. 3. Insider and institutional activity. Third reason, and this is important. The CFO entered into what's called a prepaid variable forward contract on November 13th. That's a financial arrangement that essentially lets insiders monetize shares without selling them immediately, but it signals they're looking to lock in gains. Then you've got Cathie Wood's ARK Invest selling shares. Now, ARK is known for momentum trading, so this isn't necessarily bearish long term, but when high-profile investors trim positions after a big run, retail investors notice and follow. On the institutional side, it's mixed. Rockefeller Capital Management cut their stake by 37% in Q3, but other firms like Mitsubishi UFJ increased positions. Fourth reason, the broader market has been rotating out of high multiple growth stocks. On November 20th, tech stocks got hit hard. The Nasdaq dropped 2.2%, the S&P fell 1.6%. When you're a growth stock trading at 50 times earnings, you get hit harder than the market during these rotations. Nvidia, which is the poster child for AI growth stocks, dropped 3.2% despite beating earnings. That tells you the market is in a sell first, ask questions later mode for anything trading at premium valuations. Reason 5, December Fed, uncertainty. Fifth and final reason, and this ties into our next section. Uncertainty about the Fed's December decision. The market went from pricing in a near certain rate cut to only about 35 to 43% probability. That uncertainty is weighing on rate-sensitive stocks, especially lenders. So bottom line on why the stock is dropping. It's a combination of technical breakdown after an overheated run, valuation reality check, insider profit taking, broader market rotation, and Fed uncertainty. None of this changes the fundamental story, but it explains the price action. Let's talk about the Federal Reserve because this matters enormously for a lending business. Here's where we stand right now. The Fed cut rates in September and October, bringing the target range down to 3.75% to 4%. The market was pricing in a third consecutive cut in December with near certainty a few weeks ago. Now, only about 35% to 43% chance according to the CME FedWatch tool. What changed? 3 things. First, delayed jobs data from the government shutdown finally came out. September showed 119,000 jobs added, which was more than double expectations of 50,000. That was a strong number. The unemployment rate ticked up to 4.4%, but overall, the labor market looks healthier than the Fed feared. Second, the October FOMC minutes just came out, and they show a deeply divided committee. Some Fed members think rates are still too restrictive and want to keep cutting. Others think inflation at 3% is too far from the 2% target and want to pause. Fed Chair Powell himself said a December cut is far from a foregone conclusion. Third, inflation remains sticky. The Fed's preferred measure, the PCE index, is still at 3%, well above the 2% target. Tariff inflation from trade policy is adding uncertainty. Some Fed members think tariff effects will be temporary, others aren't so sure. So what's the most likely outcome? Based on everything I'm seeing, the Fed probably pauses in December. Market is pricing 57% to 65% chance of no cut. That means rates stay at 3.75% to 4% through year end. If they do pause, they'll likely resume cuts in January 2026, assuming labor market data continues to soften. But the era of aggressive, predictable rate cuts is over. We're now in a data-dependent, meeting-by-meeting environment. What does this mean for the stock? Here's how this impacts the business. A Fed pause in December is actually not terrible for them. Let me explain why. Lower rates increase loan demand. When rates drop, refinancing picks up, personal loans increase, people borrow more. Origination volumes go up, the company benefits from that. But here's the nuance. They have a $25 billion deposit base. That's cheap funding. When rates are higher, they can still earn a solid spread between what they pay depositors and what they charge borrowers. Net interest margin stays protected. Also, lower rates typically mean better credit quality. Borrowers have more cash flow, defaults decrease. Their charge-off rate on personal loans is 3.44%, which is totally healthy. If rates drop gradually, that should improve further. The real risk isn't rates staying elevated. The real risk is rates dropping too fast, which could compress net interest margins before they can adjust deposit pricing. But a gradual cutting cycle, which is what we're likely to see in 2026, is actually ideal for them. One more thing, they've been smart about diversifying revenue. Financial services segment grew 102% year over year, tech platform grew 14%. Those businesses are less sensitive to interest rates, so even if lending gets pressured, they have other engines driving growth. My take on the Fed situation, it's a headwind in the very short term because of uncertainty, but once the Fed's path becomes clearer in early 2026, this actually becomes a tailwind. The worst case scenario for them would be rates staying at 5% or higher for years. That's not happening. We're in a cutting cycle, just a slower one than the market expected. All right, let's talk about 2026. What are the projections? What should you expect? I've looked at Wall Street consensus, and here's what the data shows. First, analyst ratings. Out of 15 to 30 analysts covering the stock, depending on the source, the consensus rating is hold. Not buy, not sell, but hold. The average price target is around $22 to $27 with a median of about $24.90. Now here's the range. The most bullish target is $38 from Mizuho. The most bearish is $12 from Barclays. That's a massive spread, which tells you analysts are deeply divided on valuation. Here's what that means. At today's price of $24.91, we're basically trading at the median analyst target. There's not much upside priced in according to Wall Street consensus. If the stock hits the average target of $24.90, that's essentially flat from here. But here's where it gets interesting. Several analysts raised targets after Q3 earnings. UBS went from $20.50 to $27.50. Goldman went from $24 to $27. Mizuho went from $31 to $38. The street was too conservative, realized the company is executing, and is now playing catch up. Let's look at actual numbers. For full year 2025, management is guiding to $2.535 to $2.55 billion in revenue, which is about 30% growth. They're also projecting adjusted EBITDA of $640 to $645 million. For 2026, Wall Street expects revenue to hit approximately $3.2 to $3.5 billion. That would be roughly 25% to 35% growth from 2025. Earnings per share are projected to go from around 0.25 to 0.27 in 2025 to about 0.28 to 0.40 in 2026. Now, some more aggressive forecasts see revenue reaching $3.540 billion in 2026, which would be 36% growth. If they hit that, EPS could climb even higher. Based on my bull case, they execute on all fronts. Member growth stays at 30% plus, margins expand further as they scale, student loans recover, crypto adoption takes off, and they hit the high end of revenue guidance. In that scenario, the stock could hit $35 to $45 by end of 2026, which would be 40% to 80% upside from here. Some of the more aggressive algorithmic forecasts see targets as high as $56 to $73 by late 2026, but I think that's optimistic. For my bear case, growth slows meaningfully. Maybe they only add 500,000 members per quarter instead of 750,000. Maybe credit quality deteriorates if the economy weakens. Maybe competition intensifies from traditional banks going digital. In that scenario, the multiple compresses and the stock could trade down to $15 to $18, which is 30% to 40% downside from here. Base case, which is where I land, they deliver solid but not spectacular growth. Revenue grows 25% to 30%, EPS hits 30 cents to 35 cents, and the stock trades in a range of $28 to $35 for most of 2026. That would give you 15% to 40% upside from today's levels, which is decent but not explosive. If you're thinking 5 years out, the projections get more interesting. Some models see the stock reaching $60 to $100 by 2028 to 2030 if they can sustain 20% plus growth and expand into new verticals. But those are very aggressive assumptions. The realistic long-term case is they become a $5 to $6 billion revenue company by 2028 with 20 to 25 million members and diversified revenue streams. If they pull that off, a $50 to $60 stock price by 2028 is achievable, which would be roughly 100% to 140% from today. Alright, what should you do right now? Here's my honest assessment. The stock is down 24% from the peak 9 days ago. It's trading around $25, which is basically at Wall Street's median price target. The fundamentals remain strong. They're profitable, growing at 30%, adding members, expanding margins, but the valuation is not cheap. At 47 to 50 times forward earnings, you're paying a premium. There's no margin of safety here. You're betting on continued execution. The Fed uncertainty adds short-term volatility, but the long-term direction of rates is down, which is a tailwind. The bigger question is whether they can sustain 25% to 30% growth into 2026 and beyond. Don't chase, wait for more downside. I'd want to see this in the low 20s, maybe 21 to 23, before getting aggressive. That would give you 10% to 15% downside cushion and better risk reward. Today's drop might be the start of that move, but I'd wait to see if we get another leg down. If you bought in the teens or low 20s earlier this year, you're sitting on massive gains. I'd consider trimming 25% to 50% to lock in profits. Let the rest ride, but take some risk off the table. Set a stop loss around $22 to protect yourself from further downside. If you bought near the top in the 30s, you're down 15% to 20%. This is tough. You can average down if you believe in the long-term story, but only if you have conviction. Don't throw good money after bad if you're uncertain. Alternatively, cut the loss and redeploy into something with better risk reward. I think this is a good company trading at a fair to rich valuation after a huge run. It's not a screaming buy here, but it's also not a sell unless something fundamentally breaks. For 2026, I expect 20% to 35% upside if they execute, with 20% to 30% downside risk if they stumble. That's not an asymmetric bet, which is what I prefer. I'd rather wait for a better entry point or see how Q4 earnings look in late January before adding exposure. But if you're a long-term believer and can stomach volatility, this pullback might be your chance to start a position or add to an existing one. That's my take on where we stand today, November 21st, 2025. Drop a comment below and let me know what you're doing with this stock. Are you buying the dip, holding, or staying on the sidelines? Thanks for watching Investment Research. If you found this helpful, hit that like button, subscribe, and I'll see you in the next one.